Next question. XYZ Limited, an Indian firm, will need to pay 5 lakhs Japanese yen on 30th of June in order to hedge the risk involved in foreign currency transaction. The firm is considering two alternative methods. First, forward market hedge. Second, currency option. On 1st of April, the following quotations like Japanese yen per rupee are available. Spot exchange rate is given to us, Japanese yen per rupee, and 3 months forward exchange rate is given to us. The prices for foreign currency option on purchase are as follows. Strike price is given to us 2.125 Japanese yen per rupee. Call option premium is given and put option premium is given. For excess or balance of the Japanese yen covered, the firm would use the forward rate as the future spot rate. You are required to recommend cheaper hedging alternative for XYZ. That is the question. Please go through the question, all of you. So friends, information is provided to us about an Indian company which is required to pay in yen currency. So either we can enter into the forward market. So simple, it is a sell of rupees and purchase of yen. And the second is a currency option. How to do currency option, that we are discussing in 5 minutes of time. I want you to write in the chat box that what is the amount payable in forward contract. So write an answer. In this question, we have to decide from an Indian company point of view, comma, whether to enter into forward market hedge or option market hedge. Heading right down, forward market hedge. In that right down, forward contract is sell of rupees and purchase of yen. The amount of the yen is 5 lakhs. This is the amount of the yen which is required to be purchased. We can see that the information is provided to us regarding spot and forward. So we are required to use this forward rate for the purpose of making calculation of answer. 1.9726 slash 1.9923, it is yen per rupee. Like that information is given. Okay. So sell of rupees and purchase of yen. Of course, you will get less amount of the yen. So the yen and rupee. 1 rupee is equal to 1.9726 yen. You are required to purchase 5 lakhs of yen. So for purchasing 5 lakhs of yen, you have to sell this amount of rupees. So the answer is 5 lakhs into 1, that does not make a sense, divided by 1.9726. So 5 lakhs upon 1.9726, that comes to 2,53,473 or 472.57. This is the amount of the rupees which you are required to sell. This is the first alternative, that is the forward market hedge. Now similarly we are required to do say for option market hedge. Now in case of the option contract, you can see that the strike price is given to us. However, we have not been provided with the information about the lot size. Let us have understanding that in case of option market hedge, how to do answer. So friends, in case of option contract, importantly we understand in order to decide whether it is the call option or put option. As I told you that say, there are two things on which you have to pay attention. One is that say, you have to pay attention about the transaction. Over here the transaction is sell of rupees and purchase of yen. That is a transaction. The second thing on which you have to pay importance is lot size. You can see that the question is not providing the lot size. So in that case, the institute has made an assumption that assuming the lot size is in your home currency, you have to make the calculation of answer. So what will happen? We understand that say purchase right to sell rupees, purchasing right to sale means purchasing of put option. So here, so the institute has made an assumption like this, because the question is not providing the information about the lot size. So assuming the lot size is in rupees term, the answer is like the suggested answer is provided. So you are going to buy the put option. With that, so the answer is required to be found. I request you to put your answer in the chat box. Chalo, write an answer. In this question, importantly, clarification is not made about lot size currency. Full stop. So we are assuming that it is of rupee currency, comma, answer is found. With paragraph write down, we are entering into option contract for sale pound, I'm sorry, sell rupees, purchase yen, comma. So purchasing right to sell means purchasing put option. Full stop. Now one by one answer will be calculated. We have been provided with the information that say as far as the put option is concerned, its premium is this amount of the yen. So Working note number 1, calculation of amount of rupees payable. What is the strike price? 2.125. So Japanese yen and rupees. 2.125 Japanese yen is equal to 1 rupee. So for 5 lakhs of Japanese yen, it is this amount of rupees. So the answer is going to be 5 lakhs into 1, that does not make a sense, divided by 2.125. So the final answer is going to be 2,35,294.12. This is the amount of the rupees which is required to be sold. Now we have to compute the premium. So working note number 2, calculation of the premium. First of all, in yen currency. So rupee and yen. You purchase right to sell 1 rupee, then in that case the amount of the premium is 0.098 yen. So you purchase right to sell 2,35,294.11 rupees, then this is the amount of the premium. So the answer is going to be 2,35,294.11 into 0.098 whole divided by 1. That is what we understand. So 235,294.11 into 0.098. That comes to 23058.82. So this is the amount of the premium that you are required to pay in yen currency. And of course we understand that so the premium is required to be paid right now. So there is a spot transaction. Working note number 3, calculation of the premium in rupee currency. For that, spot transaction is entered upon. It is sell of rupees and purchase of yen. This is the amount of the rupees to be sold for purchasing 23058.82 yen. We have been provided with the information. This is the spot exchange rate 95169711. 1.9516 slash 1.9711. It is yen per rupee. Okay. So sell of rupees and purchase of yen. So for every 1 rupee, you will get less amount of yen. So here yen and rupees. 1.9516 yen is equal to 1 rupee. So 23058.82. So 23058.82 yen is equal to this amount of rupees. So the answer is 23058.82 into 1 does not make a difference, divided by 1.9516. So 11,815.34. This is the amount of the rupees so that you are required to sell for purchasing a yen, which is supposed to be paid for premium. Now the final answer. Calculation of the overall cost. Okay. Now you can see that over here, this is the amount of the rupees payable, 235 294.12, 2,35,294.12. This is the amount payable in option plus 11,815.34. This is the premium. So the total amount is 2,47,109.46. Now this amount is going to be compared with forward market hedge. Now we have to make a comparison of forward market hedge with with option market hedge. So forward market hedge and option market hedge. 2,53,472.57 and option market hedge is 247,109.46. You make a comparison of those two and you select the lower cost, that is option market hedge. So let us have a small summary. The first alternative is forward market hedge. From an Indian company point of view, so there is a payment supposed to be made in yen currency. So sell of rupees and purchase of yen. So for every 1 rupee you'll get less amount of the yen, and with that we have made the computation of the amount to be paid in rupee currency at the end of the 3 months. Option market hedge, in that importantly the question is silent about the lot size. So ICI has given the suggested answer wherein the assumption is made that my own currency is the lot size, that is the rupee currency. Accordingly the answer is provided by them. The option currency transaction is sell of rupees and purchase of yen. Sell rupees means you are purchasing the right to sell, means you purchase put option. We understand that the amount payable in rupee currency, if at all we enter into the option contract, is 2,35,294.12. Then the amount of the premium, taking into account the put premium, we may have made the computation of the premium in yen currency. Then spot transaction for conversion of the rupees into yen, for purchasing yen, for making payment, and that comes to 23,058.82. Next is the overall cost, wherein one is the payment which is supposed to be made in the option contract, and the second is the amount of the premium. Since the rate of interest is not given to us for rupee currency, I am ignoring the interest calculation, and based on that I am making the calculation of the answer. See friends, over here surprisingly they have provided for excess of the balance of the Japanese yen cover, the firm would use forward rate as a future spot rate. But this is of no use to us. This statement would be relevant if at all some lot size information would be given to us. So in that case, for the remaining amount, we are assuming the forward exchange rate would be the spot rate as on that day. That is the way it would be relevant. Basically this statement is of no use to us as such. It would be relevant if at all there is some excess or the shortfall. In that case it would be relevant, not otherwise.